Welcome back to the deep dive. Today, we are not just looking at the numbers on a screen, we're looking at the wetware that processes them. I mean, we are opening up the hood of the human brain to figure out why, specifically when it comes to money, it seems to be, well, designed to fail.
It's a bit of a crime scene
Almost
investigation
just
today.
a crime scene.
Yeah, but the twist is that the crime scene is your own portfolio and the suspect is staring right back at you in the mirror.
That is a terrifying thought to start a Tuesday with. But okay, here's the setup. We have the stack of research articles and specifically the February 2026 Financial Insights newsletter. It's authored by Genti, Cici, a CFP, and Dr. TaiYoung Lee. And they've put forward a premise that is honestly a little uncomfortable.
Uncomfortable is exactly the right word, because we all like to think we make decisions based on logic,
Yeah.
right? On
Yeah.
data, on spreadsheets. But Cici and Dr. Lee are arguing that, well, we love to blame external factors. The Fed, inflation, the market was rigged.
Bad luck, yeah.
For our investment losses, the real destroyer of wealth is internal. It's what they call predictable psychological patterns.
Predictable is the sting there, isn't it?
It is
It implies we aren't just making random mistakes. We are making the same specific mistakes over and over, like clockwork.
exactly. And this isn't just anecdotal. This isn't just their opinion. They're pulling from a huge body of evidence advisors, surveys, meta-analyses, and specifically the DALBAR studies. For those who don't know, DALBAR tracks the gap between what the market returns and what the average investor actually captures.
And spoiler alert, the investor usually captures a lot less than the market offers.
Oh, significantly less. And to understand why, we have to go back to the bedrock of behavioral economics. The newsletter leans really heavily on the work of Daniel Kahneman and Amos Tversky.
Right. Kahneman won the Nobel Prize for basically proving that humans are not rational economic actors.
Exactly.
The old models all assumed we were Homo economicus, these perfectly logical robots who always maximize value.
And Kahneman came along and said, no, actually, we are emotional, we're irrational, and we hate losing way more than we like winning.
That is the core concept then. Loss aversion.
That frames everything we're about to discuss.
So let's drill down on that. I've heard the term, but in this context, what's the biological mechanism? Why do we care so much more about the loss?
So biologically, the pain of a loss is processed in the same part of the brain that processes, say, physical pain or mortal danger.
Oh, wow.
Evolutionarily, this makes perfect sense. I mean, if you're on the savannah and you lose your food supply, you die.
Right.
If you find extra food, it's nice, but it's not life or death. The downside has always been more dangerous than the upside is beneficial.
So we are just hardwired to prioritize safety over gain. It's a survival mechanism.
And the research suggests the ratio is about 2 to 1.
2 to 1.
The pain of losing $1,000 is roughly twice as intense as the pleasure of gaining $1,000.
Which means to even consider a risky bet, mentally, I need the potential upside to be double the downside just to feel neutral about it.
Precisely. And this wiring, it creates absolute chaos in a stock market where volatility is normal. It leads to what the newsletter calls costly holding patterns and premature sales.
We hold on to things we should sell because we don't want the pain of the loss.
And we sell things we should hold because we're terrified the gain will just vanish.
And that brings us right to the meat of this deep dive. The authors have identified 9 specific mistakes or biases that stem from this. And what I love is how they've written them out as first-person internal monologues.
It's a brilliant way to present it.
It's the lies we tell ourselves.
Yeah, instead of the academic term, they give you the thought process. It forces you to admit, okay, yeah, I've definitely thought that before.
Let's start with the big one. Mistake number 1. This is the heavy hitter. The monologue is, I want to keep the losers, as they'll come back, but sell the winners early, even if a small gain.
The disposition effect. In terms of pure financial damage, this is arguably the Godzilla of biases.
Okay, unpack the psychology. Why do I sell the winner? The old saying is, you can't go broke taking a profit, right? That sounds prudent.
That is the cliche people use to justify it. But think about the emotion involved. When a stock goes up, you feel pride, you feel smart, but you also feel anxiety.
What if it goes back down?
Exactly. You want to lock in that feeling of winning. You want to close the loop on that dopamine hit. So you sell often way too early and you cut off your long-term compounding.
Okay, so I cut the flowers because I'm anxious, but why do I water the weeds? Why hold on to the loser?
Because realizing a loss is an admission of failure. As long as you hold that stock, it's just a paper loss. You can tell yourself, oh, it'll come back. You avoid the pain of making it real.
So it's just ego protection.
It is 100% ego protection. But financially, look at what you're doing. You are tying up capital in a degrading asset while selling the assets with momentum.
It's the exact opposite of what you should do.
You are systematically weeding out your winners and keeping your losers. It's fascinating that we would rather lose money than admit we were wrong.
Okay, mistake number 2. This one is for the listeners who think they're the smartest person in the room, the monologue. I overestimate my knowledge or ability to predict outcomes and trade too much.
Overconfidence bias. And here's a counterintuitive fact from the source material. This often hits high-intelligence professionals the hardest.
Doctors, engineers, lawyers, why is that? You would think they'd be better at the math.
Well, they are good at math, but they are used to high-control environments. If a surgeon follows the procedure, the surgery works. If an engineer calculates the load, the bridge stands. They assume the market works the same way, that if they just study hard enough, they can control the outcome.
But the market is a complex adaptive system. It doesn't care about your GPA.
Not at all. And that overconfidence leads to 2 specific problems: excessive trading and under-diversification.
You trade too much because you think you know what's coming next. And every trade has a price tag: taxes, spreads, fees.
The newsletter notes that frequent trading is almost perfectly inversely correlated with returns. The more you touch the portfolio, the worse it usually performs. It's like a bar of soap. The more you handle it, the smaller it gets.
So sitting on your hands is actually a high-level skill.
It is the hardest skill. Doing nothing is incredibly difficult when you think you know something the market doesn't.
Moving to number 3. This feels very driven by the modern media landscape. The monologue is, I chase recent performance or hot trends without regard for fundamentals.
Recency bias. This is the rear-view mirror problem. We look at what just happened. Oh, tech stocks are up 20% this month, and our brains just extrapolate that line forward forever.
We assume the current trend is the permanent reality.
Exactly. And in 2026, with the sheer speed of information, this is so dangerous. By the time you see a trend on your newsfeed, the smart money has often already made the move.
You're buying at the top of the hype cycle.
You are becoming the exit liquidity for someone else. Harsh, but it's often true. You're buying the news, not the fundamental value. And usually you're buying right before the reversion to the mean.
Now, the newsletter groups the next few mistakes under themes of, like, time and social pressure. Mistake number 4 is about patience. The quote is, I want my investments to work now or very soon, or I'll bail on them.
This is myopic loss aversion, or, short-termism. The inability to delay gratification.
And I imagine this is getting worse as our attention spans get shorter. If a video doesn't hook me in 3 seconds, I skip it.
That's a perfect analogy.
If a stock doesn't pay off in 3 weeks, I sell it.
But the stock market is essentially a mechanism for transferring wealth from the impatient to the patient. Compounding takes years, decades even. It's boring. But this bias makes us reactive. If the market has a bad month, the short-term thinker bails. They sell during temporary drawdowns.
And you turn a temporary volatility into a permanent loss.
And you usually do it right at the bottom, because that's when the emotional pain is at its highest. You stop the compounding process right when it matters most.
Which segues perfectly into mistake number 5, because often we buy or sell based on what everyone else is doing. The quote, I want to make a lot of money by following what has made a lot of money recently.
Herd following. The classic FOMO. Fear of missing out.
We are social primates, right?
Well,
It feels safer to be in the crowd.
oh, it's visceral.
Even if the crowd is running off a cliff.
If your neighbor is making a ton of money on some speculative coin or meme stock, you feel like a fool for sitting out. It actually hurts. The newsletter points out that herding is what creates bubbles on the way up and crashes on the way down.
It's an amplification effect.
Right. When you follow the herd, you are outsourcing your thinking to the collective. And the collective is usually emotional, manic, or panicked. You are investing on data. You're investing on social contagion.
Speaking of outsourcing thinking, mistake number 6 is about how we consume information. The quote, I know I'm right in my opinion, and will selectively only read articles that validate my thoughts.
Confirmation bias. The echo chamber.
This is so easy to do now. If I'm bullish on a stock, I can find 10 articles telling me it's going to the moon.
And the algorithms feed this.
Oh, yeah.
If you click on one bullish article, your feed gives you 5 more. You stop seeing the risks. You stop seeing the counterarguments. You effectively blind yourself to reality.
You think you're doing research, but you're actually just seeking validation.
That's a key distinction. Real research is trying to prove yourself wrong. Most people are just trying to feel right.
Okay, let's look at the final group. These feel more like structural errors, how we actually build the portfolio. Mistake number 7. I want to put most or all of the money in a few stocks, since I know they'll definitely be winners.
Concentration risk. This is the all your eggs in one basket problem.
But wait, I have to play devil's advocate. Isn't that how billionaires get rich? I mean, Elon Musk, Jeff Bezos, they were highly concentrated in one company.
That is true. Concentration is how you get rich, if you're lucky and talented and working at the company. But diversification is how you stay rich.
Ah, okay. That's a vital distinction.
For the average investor, concentration brings the risk of total ruin. If you own the S&P 500, you'll effectively never go to zero unless the global economy collapses. But if you own 3 biotech stocks, you could lose 90% of your wealth in a single FDA announcement.
So it's about asymmetric risk again. The upside of concentration doesn't justify the risk of ruin for most of us.
Exactly. The newsletter warns about severe drawdowns. Most people cannot stomach a 50 or 60% drop. They will panic sell. Diversification smooths that ride so you can actually stay in the seat.
Mistake number 8. This one's a mental trap about price. The quote, I know this stock will come back since at one point it was at this very high price.
Anchoring bias. You anchor on that high water mark. It used to be $100. Now it's $50. It's cheap.
Maybe the company is half as valuable now.
That is the danger.
Yeah.
You're ignoring new information. Maybe the CEO quit, the product is obsolete, regulations change. You're judging the value based on a past number that's now completely irrelevant.
The market doesn't care what you paid for it.
And it doesn't care where it used to be. It's like refusing to sell a house for market value because it was worth more in 2021.
Yeah.
You're fighting reality.
Mm.
And you're losing opportunity costs while you wait.
You're frozen by the anchor.
Yep.
Finally, mistake number 9. The authors say this one acts as an amplifier for all the others. The quote, I just want to make money, regardless of a plan or what the money is for.
The lack of a disciplined strategy? Basically, investing without a policy statement.
Making money isn't a strategy.
No, making money is a wish. A strategy is a plan for how you navigate uncertainty. If you don't have a written plan, and I mean literally written down, then every time the market moves, you have to make a new decision.
And every time you make a decision, you burn willpower.
And you open the door for all the demons we just discussed. If you don't have a rule about rebalancing, loss aversion will stop you. If you don't have a rule on asset allocation, recency bias will make you chase trends.
So the lack of structure is the playground for all these errors.
Absolutely.
So if we sum this up, we are battling a 9-headed hydra of disposition, overconfidence, recency, short-termism, herding, confirmation, concentration, anchoring, and no strategy. It sounds exhausting.
It is biologically expensive to fight this. Your brain wants to do the easy thing, and in investing, the easy thing is almost always the wrong thing.
So let's talk impact. We've listed the crimes. What's the sentence? What does this cost us in real dollars?
The newsletter is stark here. They estimate these behavioral gaps cost investors anywhere from 3 to 4% per year in returns.
3 to 4%. Now, to a casual listener, that might not sound like a crisis. Oh, I made 6% instead of 10. Big deal. Why does that matter so much?
It's a huge deal because of compounding.
Right.
If you compound, say, $100,000 at 10% over 30 years, you have about $1.7 million. If you do it at 6%, you have about $570,000.
Wow. So that small behavioral gap cost me over $1 million?
Exactly. You are potentially cutting your final wealth in half or worse. And remember that 3 to 4% is an average. In years of extreme panic or euphoria like 2008-2020, or the AI bubble, investors can destroy a decade of wealth in a single week of panic selling.
The cost is astronomical.
Yeah.
Okay, that's the terror. We know the problem is our own brains. Now give us the hope. The newsletter outlines 4 specific countermeasures to stop us from lighting our money on fire. What's step 1?
Step 1 is what I like to call the Ulysses Pact. Establish a written investment policy statement, or IPS, upfront.
Like Ulysses tying himself to the mast so he wouldn't steer the ship into the rocks when he heard the sirens.
Exactly. You write down your asset allocation, your goals, your rules for selling before the market crashes. You make the decision while you're rational so you don't have to when you're emotional.
It's a contract with your future self. Dear future me, do not sell just because the news is scary.
That's the idea.
Yeah.
It creates an objective standard you have to answer to.
And step 2 helps operationalize that contract.
Right. Implement rules-based rebalancing and systematic reviews.
Rules-based just means automatic.
Systematic. For example, if my stock allocation grows to 65%, I automatically sell back down to 60. It forces you to do the thing that feels unnatural. Sell high and buy low.
You don't do it because you feel like it. You do it because the rule says so.
It removes the emotion. You aren't taking a view on the market. You're just maintaining the machine.
Step 3 might be the hardest one for me personally. Limit exposure to short-term noise.
The digital detox advice. The authors specifically suggest reducing daily market checks.
But I need to know what's happening.
Do you, though? If you look at your portfolio every day, statistically, you're going to see it down about 47% of the time. It's stressful. You feel that loss aversion constantly.
But if I look once a year,
The odds of it being up are much, much higher.
so looking frequently just increases my anxiety without increasing my returns.
It increases anxiety and the likelihood that you will tinker. In investing, ignorance of the daily fluctuations is bliss and profit.
And finally, step 4, because sometimes willpower isn't enough.
Seek objective accountability. This is the role of a good financial advisor or even a trusted third party,
A designated driver for your money.
someone who isn't emotionally attached to your retirement. When you call them in a panic saying, I want to sell everything, their job is to pull out that policy statement and say, no, we agree we wouldn't do that.
They provide the friction.
But they save you from yourself. They act as the circuit breaker between your impulse and your action.
This brings us to the core philosophy of the newsletter, which I think is a great mantra for 2026. Discipline and process outperform emotion and intuition over time.
It's not about being smarter than the market. It's about being more disciplined than your own instincts. You don't need to find the next Amazon to be successful. You just need to stop tripping over your own feet.
That's remarkably empowering, actually. It means success isn't about having a high IQ. It's about having a high EQ, emotional control.
Competent and consistent beats brilliant and erratic every single time. The tortoise beats the hare because the hare gets distracted, overconfident, and takes a nap.
So as we wrap up this deep dive into our own psychological flaws, I want to challenge the listener. Think back to those internal monologues we read. I'll sell when it gets back to even. I know this stock is a sure thing.
Did any of those make you wince? Did you feel seen?
If they did, that's good. That's the first step. Recognizing the voice is how you stop listening to it.
And I'll leave you with this thought to chew on. We've established that our brains are biologically wired hardware code from millions of years ago to fail at investing. We feel loss twice as hard as gain. We herd for safety. We fear the unknown.
We are hunter-gatherers trying to day trade.
Right. So knowing that, is it actually arrogant to think you can do this entirely alone? If the biological deck is stacked against you, perhaps the only way to truly win isn't to try harder, but to admit defeat and build a system, use rules, or hire an advisor that completely bypasses your brain.
Can we create a system that is smarter than its creator? That's a big question. Thank you to Genti, Cici, and Dr. TaiYoung Lee for this reality check. And thank you for listening to The Deep Dive.
Stay disciplined.
We'll see you next time.